You are probably standing in your kitchen right now. Maybe you are grabbing your lunch at work
Yeah.
or, popping a container into the microwave.
Right. Something we all do every day.
Exactly.
Yeah.
And if you look closely at that clear, heavy glass bowl holding your food, there is a very good chance it has a specific logo stamped right on the bottom.
Oh, definitely. Or even step out of the kitchen for a second and flash back to high school chemistry.
Oh man, chemistry class.
Yeah. Picture that glass beaker sitting over a roaring Bunsen burner, right? Just completely unfazed by the open flame. You have interacted with this material countless times.
And I am willing to bet you have never once stopped to think about the massive high-stakes business empire that's operating behind that single, unassuming piece of glass.
Most people definitely haven't.
Right. I mean, we're talking about an operation where the product itself is literally transparent, but the mechanics of how it gets made, shipped, and defended against fierce competition, well, that is incredibly dense.
It really is. The sheer physical reality of manufacturing that glass is honestly a brutal undertaking. Yeah.
We are looking at a company that has to master extreme thermal physics on a factory floor and then, navigate the chaotic logistics of Indian retail while simultaneously meeting the microscopic purity standards of global pharmaceutical labs.
It's just wild to think about. So for our mission today, we have a comprehensive stack of sources. We've got strategic growth profiles, deep market analyses, and some really recent financial performance data on Borosil Limited.
The objective here is to basically pull back the curtain. We want to see how a seemingly basic manufacturing company, one dealing in heavy, fragile, energy-intensive physical goods, how it actually operates, scales, and fights for its turf in the modern Indian economy.
Okay, let's unpack this, because to really understand this company, we first have to break down exactly what they sell and, who they are selling it to.
Absolutely.
You have to look right past that standard consumer perception. The idea that this is just the company that makes the baking dish your family has used for 20 years. Yeah, that's just the tip of the iceberg. To visualize the structural core of the company, I want you to imagine a split screen.
Okay, I'm picturing it.
So on one side, you have a bustling, modern Indian kitchen. It features smart appliances, modular storage, and a family sitting down to dinner.
Very relatable.
Right. But on the other side of the screen, you have a highly sterile, high-tech pharmaceutical testing lab. Technicians in clean room suits handling volatile chemicals.
Oh, wow. That's a stark contrast.
It is, and that duality, that is the entire essence of the business. It is a consumer retail brand and a critical industrial supplier, both operating under the exact same corporate umbrella. If you only analyze the consumer side, well, you are entirely missing the underlying economic engine.
That makes a lot of sense.
Yep.
So let's examine that consumer side first, just since it is the most visible to you and me.
Sure.
We are talking about microwave-safe cookware, flame-proof glass, and heavy-duty storage containers. But based on the strategic profiles we have, they have aggressively pushed far beyond just clear borosilicate glass.
Oh, they definitely have.
Right. Like they acquired a brand called Lara, which produces Opalware. And for anyone who hasn't shopped for dinnerware recently, Opalware is that opaque, usually white glass that looks and feels like premium bone china.
Yeah, but significantly tougher.
Exactly. Tougher and also vegetarian friendly because it contains absolutely no bone ash. And alongside that, they're pumping out stainless steel lunch boxes, hydration bottles, and even small electrical kitchen appliances.
Right, like sandwich makers and toaster ovens.
Yeah, exactly.
So the end user in that division is the everyday retail consumer. It is the household upgrading their kitchen aesthetics, or maybe someone buying a wedding gift, or, a family transitioning away from plastic storage due to health concerns.
Makes sense.
It is a mass market, high visibility play that really depends on shifting consumer trends. But when you look at the other side of that split screen, the scientific and industrial division, the entire operational paradigm just shifts completely. Well, here, they are manufacturing laboratory glassware, things like volumetric flasks, test tubes, and precision measuring cylinders.
Right, the high school chemistry stuff we mentioned.
Exactly. But also, they are producing primary glass packaging for pharmaceutical drugs. They make the vials that hold vaccines and highly specialized lab consumables used in industrial research.
So the customer profile just flips completely then.
Entirely.
Instead of a family browsing a supermarket aisle, the buyers are these massive universities, global pharmaceutical manufacturers, industrial research and development labs.
Chemical plants, yeah.
It reminds me of a Hollywood actor who balances their career perfectly.
Oh, I like this analogy.
Yeah, so the consumer products, those are the blockbuster action movies.
Hmm.
They have mass appeal, heavy marketing. Everyone recognizes the brand name on the shelf.
Yeah.
And they generate a ton of mainstream revenue.
Right, the popcorn flicks.
Exactly. But the scientific products, those are the critically acclaimed independent films that sweep the technical awards. They are highly specialized, incredibly demanding to produce, and deeply respected by a very specific, discerning audience of scientists and procurement officers.
That is a great way to look at it. And, that structural duality, it provides a formidable baseline of resilience for them.
How does that play out in the numbers?
Well, it creates fundamentally diversified demand. The blockbuster consumer goods rely heavily on household sentiment, right? Rising disposable incomes, the success of marketing campaigns. It is a discretionary spend.
Yeah, if times are tough, maybe you don't buy a new dinner set.
Exactly. If the broader economy dips, a family might delay buying that premium Lara Opalware. However, the scientific and industrial demand is anchored to strict regulatory compliance.
Oh, interesting.
It's driven by recurring institutional procurement budgets and rigorous quality standards. A pharmaceutical company testing a new drug formulation does not stop buying sterilized test tubes just because consumer confidence dropped in the last quarter.
That makes total sense. It basically functions as an internal hedge. When the blockbuster has a slow season, the critically acclaimed technical division is still pulling in steady, loyal institutional orders.
Absolutely.
But, knowing the categories they play in only brings us to the next logical hurdle in our deep dive. I mean, a great product mix means nothing if the ceiling for growth is too low.
Right. You need room to run.
Exactly. We have to size the prize. The sources outline the total addressable market, or the TAM, and the numbers are just massive.
Oh.
Let's look at the consumer TAM first.
Okay, so the estimated total addressable market for the relevant consumer categories in India sits somewhere between 25,000 to 45,000 crores annually.
Wow. That is a huge range, but also just a huge number in general.
It is. And to understand how the analysts arrive at a number that large for everyday household items, you have to look at the underlying demographics. The base calculation targets the addressable urban and aspirational middle-class households in India.
And how many households are we talking about there?
Currently, that number is around 100 to 150 million households.
Okay, but wait. That implies every single one of those households is spending thousands of rupees a year, specifically on containers, plates, and small appliances. I have to push back a bit on the upper end of that 45,000 crore estimate.
I get that.
Are families really replacing their dinnerware and lunchboxes that aggressively year over year?
Well, the spending is not just on replacement, right? It is driven by a broader lifestyle shift.
Okay, walk me through that.
If a household spends 1,500 rupees a year, perhaps buying a new set of glass storage bowls and a stainless steel water bottle, you hit that lower bound of roughly 15,000 to 22,500 crores.
Right.
But if they upgrade a kitchen appliance or buy a premium Lara Opalware set for a festival, the annual spend jumps to 3,000 rupees. And that pushes the market size past 40,000 crores.
Oh, I see.
The expansion is really fueled by rapid urbanization. Families are moving into apartments with modern modular kitchens. And in those spaces, space efficiency and visual aesthetics matter deeply.
Yeah, nobody wants a mismatched tower of stained plastic containers sitting on a beautiful granite countertop.
Exactly. It just doesn't fit the lifestyle.
And there's also the health and premiumization angle, right? We are seeing a massive cultural migration away from cheap, unbranded plastic.
Oh, completely.
People are increasingly aware of microplastics and chemical leaching, especially, when heating food in microwaves. They actively want non-toxic, chemical-resistant materials like borosilicate glass or high-grade stainless steel touching their food.
Right. Now, turning to the scientific TAM, the dynamic is completely different, but it's equally vast.
What are the numbers looking like there?
The scientific market in India is estimated between 8,000 to 20,000 crores. And the unit economics of outfitting and supplying a laboratory, well, they provide a reliable, recurring revenue stream.
How much does a typical lab actually spend?
A small, independent diagnostic or testing lab might have an annual recurring spend of 1 to 3 lakhs just on consumable glassware.
Wow, just on the consumables.
Yeah, because they break things, they use things up, and they just have to order more. It's constant. And larger pharmaceutical clients and massive research institutions, they spend 5 to 20 lakhs regularly, year after year.
That is incredible. The structural drivers in the B2B space, seem almost stronger than the consumer side, honestly.
I would argue they are.
I mean, India is really cementing its position as the pharmacy of the world. As domestic pharmaceutical manufacturing expands, and as industries increase their research and development intensity, they just need more testing equipment.
Exactly.
There's also a major national push for import substitution. Companies and government labs are actively looking to buy from high-quality domestic suppliers rather than importing expensive European glass or, relying on inconsistent Chinese imports.
Spot on. And, the white space for growth in both the consumer and scientific markets, it is not about inventing new demand.
What do you mean?
Well, it is not about convincing a household that they need a plate or a lab that they need a flask. They already use those things. The open runway is entirely about formalization and upgrading.
Ah, I see.
Borosil's opportunity lies in shifting a consumer away from the unbranded, locally injection-molded plastic lunchbox they bought at a neighborhood stall and converting them to a formalized, branded alternative.
Right.
And in the scientific space, it is about moving a mid-tier laboratory away from fragmented local glass blowers to standardized, certified, branded procurement.
Okay, so that reveals the true nature of the battlefield. I mean, a combined addressable market north of 65,000 cores is incredibly lucrative.
Highly lucrative.
But that much money attracts ruthless, well-capitalized competition from literally every angle. You've got local unorganized players competing on pure price and international giants competing on prestige.
It's a war zone out there.
Right. So to survive in a market that large, a company needs a fortified moat. The sources detail 4 main pillars that Borosil uses to defend its territory. Let's start with brand.
Okay, so the brand positioning is highly calculated. They occupy what analysts call the mass premium tier.
Mass premium, right?
They are conspicuously absent from the bargain bins, but they also actively avoid positioning themselves as an unattainable luxury item.
So they're right in that sweet spot.
Exactly. The brand signifies trusted, durable quality at a price point that an aspirational middle-class family can actually justify.
Makes sense.
And the acquisition of the Lara brand was a masterstroke in this regard because it allowed them to capture the dining room table, not just the kitchen cabinet.
Oh, that's a great point.
They bought an established name in Opalware and just injected it with their existing manufacturing and marketing muscle.
Which brings us to the second pillar, distribution. This is where the physical reality of India's geography really comes into play. Because having a trusted brand is totally useless if the product isn't on the shelf when the customer walks into the store. Borosil manages a sprawling network of over 15,000 retail outlets. I mean, they have secured prime placement in modern trade supermarkets, they've built a massive direct-to-consumer e-commerce presence, and they maintain these crucial vendor relationships with the canteen stores department, supplying the military canteens.
Yeah, and managing 15,000 physical touchpoints across a country with infrastructure as complex as India's, I mean, that is a monumental task.
Especially when your primary product shatters if you drop it.
Exactly. It requires decades of relationship building with regional distributors, optimizing packaging to survive really rough transit, and negotiating shelf space literally inch by inch.
It's not something you could just copy overnight.
No, not at all. A well-funded startup can run a beautiful digital marketing campaign overnight, sure, but they cannot instantly replicate a logistics network that places fragile glassware safely into 15,000 physical storefronts.
Right, so the third defensive pillar is their technology and manufacturing know-how. And the sources point out this isn't like assembling electronics from pre-made components.
It's far from it.
Manufacturing scientific-grade borosilicate glass requires extreme thermal control. You are dealing with furnaces running constantly at blistering temperatures, blending silica sand and boron trioxide, and ensuring the final product can withstand severe thermal shock.
Right, like going straight from a freezer into a hot oven without cracking.
Exactly. And the process discipline required to maintain consistent thickness and structural integrity, that creates a very steep barrier to entry for newcomers.
Which seamlessly feeds into the fourth pillar, the ecosystem effect.
Right.
The cross-selling potential is just immense. If a consumer purchases a glass baking dish, uses it repeatedly at high heat, and builds trust in its durability, that psychological trust transfers to the brand's other category.
Yeah, I've done that myself.
Right. When that same consumer needs a stainless steel hydration bottle for the gym or maybe a sandwich maker for their kitchen counter, the Borosil logo signals reliability to them.
They already trust the name.
Exactly. They leverage the trust built in heavy glass to capture a wider share of the overall household wallet. What's fascinating here is that while those four pillars, brand, distribution, manufacturing, and ecosystem, while they look impregnable on a strategic presentation slide, the market analysis reveals severe cracks in the defense.
Yeah, the mode is definitely far from impenetrable.
No, it's not.
The first major vulnerability is just the reality of low switching costs, particularly in the consumer division. I mean, a household is not locked into an ecosystem the way they are with, say, a smartphone operating system.
Right, there's no technical lock-in.
Exactly. If a competitor runs an aggressive deep discount campaign on a beautiful Opalware dinner set on a major e-commerce platform, the consumer can easily switch. There is no penalty for buying a different brand of lunchbox.
Furthermore, they lack a true network density moat.
Explain that a bit more.
Well, a software platform becomes inherently more valuable to its users as more people join it, right?
Right, like a social network.
Exactly. But Borosil's products do not improve simply because your neighbor also bought one.
That's a good point.
Every sale is a singular transaction that has to be won on its own merits over and over again. And critically, their perceived cost advantage is under constant assault.
From the local players, right?
Right. They achieve economies of scale, certainly, but they are relentlessly undercut by the unorganized sector. Local manufacturers who just ignore environmental compliance, skip thermal stress testing, and pay lower overheads, they can flood the market with visually similar, cheaper alternatives.
It's crazy. The reality is that Borosil is not coasting on an unbreakable technological monopoly. They are engaged in grueling daily trench warfare for shelf space, consumer mind share, and these fractional margin advantages.
Absolutely.
And that operating reality demands we trace the actual flow of rupees through the company. I mean, having a legacy brand and 15,000 retail partners is a compelling narrative, but we really need to see how that physical footprint translates into actual cash flow.
Yes, let's look at the numbers. The revenue formula driving their economic engine relies on three distinct levers.
Okay, what's the first one?
The first is pure volume growth. This is simply pushing more units out the factory door.
Right, selling more stuff.
Yes. The second is mix shift, and this is really crucial. It means actively steering the sales volume toward higher margin items.
Coming.
Instead of just selling basic, clear glass tumblers, they push the intricately designed Lara Opalware, or those premium electrical appliances we talked about.
Which make them more money per item.
Exactly. And the third lever is pricing power, which tests the strength of their brand moat by passing small incremental price hikes onto the consumer without losing sales volume.
Got it.
Historically, this engine has demonstrated serious momentum. The financial data indicates their revenue scaled from roughly 365 crores in financial year 19 to 839 crores by financial year 22.
That top line growth is impressive, but, revenue is just a vanity metric if the production costs are totally out of control.
That is the hard truth of manufacturing.
Right. And the margin mechanics of glass manufacturing are defined almost entirely by heavy fixed costs. When you build a glass factory, you are installing massive furnaces that require staggering amounts of energy to reach melting temperatures.
Immense amounts of power.
And crucially, you cannot just turn a glass furnace off over the weekend when demand is slow. They run 24 hours a day, 7 days a week.
And that continuous energy burn creates a phenomenon known as operating leverage. When the company is operating below its break-even point, the financial pain is incredibly acute because that massive cost of keeping the furnaces hot, it remains completely static while revenue falls.
It operates exactly like pushing a massive heavy boulder up a steep hill.
Oh, I like that image.
Yeah, think about it. The upfront effort is agonizing. You are pouring capital into building the factory, paying for the energy, and setting up the distribution network before you have sold a single bolt.
Right, all money out the door.
But once you push that boulder over the peak of the hill, the physics completely flip. Gravity takes over, and the momentum is unstoppable.
Exactly.
Once Borosil covers those immense fixed costs, every additional glass container they produce and sell drops almost entirely to the bottom line as pure profit. The profits multiply exponentially faster than the revenue.
And the historical financials validate that boulder analogy perfectly. During their peak scale-up phases, when their plants were running at maximum utilization, their capital efficiency metrics were just outstanding.
What were the numbers?
They were hitting a return on capital employed of around 18% and a return on equity around 11%.
Very solid.
Yeah. When the manufacturing infrastructure is fully utilized, the cash generation is incredibly strong. However, operating physical infrastructure creates a secondary financial trap that asset-light companies never have to face:
And what's that?
the working capital drain.
Right. Rapid growth in physical manufacturing devours cash.
Yeah.
I mean, a tech company can scale its software to 1 million new users overnight with minimal capital outlay.
Right.
But Borosil has to buy raw materials, manufacture fragile inventory, and store it all in vast warehouses.
Yeah, the physical reality of the goods.
They have to hold massive buffer stocks ahead of major shopping events, like Diwali or the wedding season, just to ensure they don't stock out.
And that the cash gets trapped not just in warehouses, but in the accounts receivable ledger as well.
How does that work?
Well, as Borsil shifts away from small, upfront paying mom-and-pop stores and pushes deeper into modern trade supermarkets and institutional hospital procurement, the payment cycles lengthen dramatically.
Ah, because big companies dictate terms.
Exactly. A massive hospital chain or a national supermarket brand might take 60 to 90 days to settle an invoice. Yeah, so the company can show beautiful top-line revenue growth and excellent paper profits on the income statement, but the actual cash in the bank might be dangerously low because it is completely locked up in unsold dinner plates and pending invoices.
That working capital tension really dictates their entire strategy for the future. I mean, the management team, led by CEO Srivar Karuka, has laid out a roadmap for the next 10 years, and it is strikingly grounded.
Very grounded.
The sources reveal no sudden pivots into artificial intelligence, no speculative attempts to invent a new category of smart kitchen robotics.
No buzzwords.
Right, none. The
Yeah.
mandate is pure execution. They're taking their existing industrial machine and aggressively attempting to run it faster, wider, and more efficiently.
And the growth vectors they have identified are deeply operational.
Walk us through them.
Okay, first is deeper penetration and premiumization. The objective here is to extract more value from their existing customer base. If a customer is comfortable buying a standard glass lunchbox, the goal is to upsell them to the premium insulated stainless steel hydration and meal kit.
Right. Get them to spend a bit more.
Exactly. They want to shift the average order value higher across every single transaction.
Makes sense. The second vector addresses the physical reality of their business, which is capacity expansion. In the software world, capacity is virtually infinite, right? But in glass manufacturing, the capacity of your furnace dictates your absolute sales ceiling.
Period.
If you cannot melt more glass, you cannot sell more bowls, no matter how much demand your marketing team generates. So they are committing serious capital to building new plants and adding more furnaces to raise that absolute ceiling.
And the third vector focuses on geographic and digital expansion.
Okay, where are they heading?
They are pushing their physical distribution network deeper into Tier 2 and Tier 3 Indian cities. They are basically chasing the rapidly expanding aspirational middle class in those regions.
That's a huge market.
It is. And simultaneously, they are leaning heavily into direct-to-consumer e-commerce. Digital storefronts are vital because they totally bypass the physical limitations of a supermarket shelf.
Right, space is limited in a physical store.
Exactly. A retailer might only allocate space for 20 Borosil items, but the website can display their entire catalog of thousands of SKUs.
That's a huge advantage. And the final growth lever brings us right back to the structural shift in the Indian economy, which is formalization.
Yes.
They are positioning themselves to patiently absorb market share as the unorganized sector gets squeezed out. As the government enforces stricter safety standards, as consumers demand higher quality, and as digital discoverability becomes paramount, those small local operators inevitably fall behind.
Right. They can't keep up.
And Borosil just has to stand ready with enough capacity to absorb those migrating customers.
The overarching theme of this roadmap is that the next decade will not be won by some singular disruptive genius idea. It will be won through 1,000 grueling, incremental victories on the factory floor and in the supply chain.
Death by 1,000 cuts, but in a good way.
Exactly. Success looks like shaving 0.5% off the raw material scrap rate, optimizing a shipping route to reduce breakages by a fraction, or negotiating a slightly better end cap display at a national grocery chain.
It is absolute trench warfare for operational efficiency.
Truly.
But, strategic roadmaps always look clean and linear on paper until the reality of the market hits.
Oh, always.
We have to examine the vulnerabilities that could shatter this growth narrative. The sources outline several highly specific, tangible threats that extend far beyond generic macroeconomic worries.
And the most immediate is the intensifying competition.
Yeah.
The consumer market is currently flooded. It is not just local, unorganized players anymore. They are defending their premium pricing against aggressively priced, imported substitutes that honestly look identical to the untrained eye.
Wow.
Yeah, every time they're trying to pull the pricing power lever to improve margins, they risk losing volume to a cheaper rival.
The regulatory risks highlighted in the sources are also particularly severe, especially concerning their newer appliances division.
Also,
Well, when you transition from making glass bowls to manufacturing electrical sandwich makers and toaster ovens, you fall under the strict oversight of the Bureau of Indian Standards and Quality Control Orders.
right, the compliance goes way up.
And the bureaucratic friction is immense. A sudden regulatory update regarding the required thickness of an internal copper wire, or maybe a modification to a plug standard, it can instantly render thousands of units sitting in a warehouse illegal to sell.
That is terrifying for a business.
It really is. It halts supply chains, delays highly anticipated product launches, and forces the company into expensive, rapid redesigns.
Then there is the unavoidable reality of input cost volatility. The extreme heat required for glass manufacturing means they are heavily reliant on liquefied petroleum gas and electricity.
Right, the furnaces.
Exactly. They also require high-grade soda ash. And the prices of these imports are completely outside the company's control. A geopolitical conflict that spikes global energy prices, or a currency fluctuation that makes importing raw materials vastly more expensive, it immediately and ruthlessly crushes their gross margins.
Just wipes them out.
Yeah. If we connect this to the bigger picture, the sources outline a terrifying operational scenario. The real danger to Borosil isn't just one of these risks materializing in isolation. The investment thesis completely unravels in what analysts call a squeeze scenario.
Okay, break down the squeeze scenario for us.
The squeeze is the dark side of the operating leverage we discussed earlier. Imagine a quarter where intense competition forces Borosil to drop prices, resulting in lower revenue volume.
Okay, so less money coming in.
Right. And simultaneously, a global energy shock spikes the cost of the fuel keeping their furnaces burning. Because those fixed costs are sticky and the furnaces cannot be turned off, their profit margins collapse inward. It gets worse. As profits vanish, their cash gets trapped in unsold inventory, piling up in warehouses due to the lower sales volume. So they face volume drops, margin compression, and severe working capital stress, all at the exact same time.
That is a perfect storm.
It is. The financial momentum swings aggressively in reverse, burning through cash reserves at an alarming rate.
And this isn't just some theoretical exercise in risk management, right? The recent financial reality check provided in the source documents shows that the company is currently navigating extremely turbulent waters.
They definitely are.
The financial data from the last 12 to 24 months presents a glaring contradiction. The revenue engine is still firing. For example, in the second quarter of financial year 26, sales were up 22.33% year over year, hitting 340.36 crores.
Which is great. They are successfully pushing more volume out the door. Yet the profit engine is sputtering badly. Their operating margins have been highly volatile, oscillating between 14 and 16%. And the bottom line profitability has taken severe hits.
What do the recent numbers look like?
In the third quarter of financial year 26, net profit plummeted by a staggering 32.5%.
Wow, 32% drop.
Yeah. The raw translation is that it is costing them significantly more to generate every new rupee of sales. They are selling more goods, but they are keeping substantially less of the money.
That is not a sustainable trend. And the most alarming data point in the entire analysis is the market share metric.
Oh, this is the big one.
Over a 5-year tracking period, Borosil's market share in its core categories declined from 27.4% down to 21.01%.
That decline reveals a massive leak in their competitive armor. The overall market size in India is expanding rapidly, but competitors are capturing that newly generated demand at a much faster rate than Borosil.
They are losing their grip on the expanding pie.
Exactly, and the public markets are ruthless when they spot a squeeze combined with market share loss. The stock performance reflects this precise anxiety. It has dropped somewhere between 36 and 39% over a 1-year time frame.
So what does this all mean for the ultimate trajectory of the company? I mean, the management track record offers some crucial context here, doesn't it?
It does. The Karuka family has navigated the brutal realities of Indian manufacturing for 5 decades.
Right, and CEO Shrivar Karuka holds a substantial 38.7% stake in the company. So they have real skin in the game.
Huge skin in the game. Their capital allocation strategy is highly aggressive toward internal reinvestment. They are actively hoarding capital to fund the capacity expansion and fight this turf war rather than, stripping cash out of the business to pay high dividends.
They're building for the long term.
My synthesis of the data is that Borosil possesses a fundamentally sound, highly resilient core, but they are currently trapped in a brutal execution crucible.
A crucible, yeah.
The dual engine structure of consumer and scientific divisions provides a robust floor, and the broader demographic tailwinds of Indian urbanization are entirely in their favor. However, management is actively choosing to sacrifice short-term margin stability to rapidly build out manufacturing capacity.
They are betting the balance sheet on the future.
Exactly. The critical imperative right now is plugging that market share leak. They have to prove decisively that their mass premium brand equity can endure a prolonged period of intense price competition and elevated energy costs without losing relevance in the eyes of the consumer.
It is the ultimate test of physical manufacturing. I mean, they have to keep those massive furnaces burning at optimal temperatures, keep the sprawling distribution channels fully stocked, and fiercely defend every square inch of retail shelf space across the country.
It's exhausting just thinking about it.
It really is. Borosil is an incredibly complex machine straddling the modern home and the specialized scientific laboratory. It is powered by deep brand trust, but it is constantly fighting against the heavy, fragile, energy-intensive realities of making physical goods in a really volatile geopolitical landscape.
This raises an important question regarding how we value businesses today.
I'm intrigued.
Well, we live in a commercial era overwhelmingly obsessed with software, artificial intelligence, cloud computing, and these asset-light platforms, right?
Yeah.
We celebrate companies that can scale globally with a few keystrokes.
Yeah, tech giants.
But the physical world remains undeniably real. It still needs to be built, measured, cooked in, and stored safely. Borosil's current margin struggles, alongside their 50-year history of survival, demonstrate that dealing with the massive fixed costs and brutal logistics of physical manufacturing is incredibly difficult.
Totally different skill set.
It requires a level of operational discipline that most software companies will never have to develop. But, a well-built physical machine is also incredibly durable.
That is the exact thought I want you, the listener, to ponder as we conclude this deep dive. I mean, if you had to wager on a business surviving and remaining relevant for another 50 years, where would you place your confidence?
It's a tough call.
Would you bet on a revolutionary piece of software code that could easily be rendered entirely obsolete tomorrow by a slightly faster, newly invented algorithm? Or would you place your bet on the heavy, physical, heat-resistant, borosilicate glass beaker?
The beaker that science fundamentally relies upon.
Exactly. The fundamental, unchanging tool that scientific discovery, medical testing, and even your own kitchen will reliably always need.
It is definitely something to think about the next time you pull that heavy glass container out of the microwave.
It really is. Thanks for joining us on this deep dive.